Hey there, I'm Dustin with the Simple Dollar. So a common question in personal finance is, should you increase your deductible to save money on insurance? That's what we're going to cover in today's video. If you're new to the channel, welcome to the Simple Dollar. We do videos on personal finance, investing, and everything related to your money. So make sure you drop down and subscribe so you don't miss future videos. If you get any value from this video, we'd really appreciate it if you drop down and hit the like button as well. And then after you watch this video, make sure you head over to thesimpledollar.com where we have way more resources on how to manage and save your money. So before we jump into it, let's define a couple terms. So with insurance, you have premiums and you have deductibles. So with premiums, those are the amounts that you pay to basically get access to insurance. So these are the amounts that you're paying to the insurance companies, maybe on a monthly basis, could be quarterly or even annually. Think of your premiums as buying access to insurance coverage. On the other hand, we have deductibles. Deductibles are the amounts that you have to pay up front whenever you file a claim. So take, for example, we've got a $1,000 deductible and a storm comes through and it ends up costing us a $5,000 repair. If we file an insurance claim on that event, we're going to have to pay the first $1,000 and then the insurance company should come in and pick up the next $4,000. So now a lot of people get upset when they think about deductibles because you're already paying your insurance premiums. Why do I have to pay more to get access to my insurance I'm already paying for? And the real reason is it sets up an incentive structure that benefits not only the insurance company, but also keeps insurance costs down. Think about what would happen if there was no deductible. For one, you're going to file a lot more little claims. You can imagine how many $20, $30, even $50 claims that people are going to be filing if they don't have any deductible to meet. And also, if you didn't have a deductible, there's a lot more incentive now to file a claim. Because there's no out-of-pocket expense to you, you're much more likely to try to file a claim against the insurance. All of that additional activity is going to add cost to insurance companies, and that cost is then going to be passed back on to consumers. So generally what you have is an inverse relationship between premiums and deductibles. The higher your deductible is, the lower your premium should be. On the flip side, if you want a low deductible, it's probably going to cost you more in terms of your premium. We'll leave a link in the description below with more information about how this relationship works. So I think in general, when you're trying to determine what type of deductible you want to have, if you want to increase it or leave it the same or get a lower deductible, you need to think about why we have insurance at all. And really the main purpose of having insurance is to insure against a catastrophic or major significant event that would cause us financial harm. Let's say, for example, that your house burns down. For most people, a home makes up such a significant piece of their assets that it's going to be difficult, if not impossible, to ever recover from that. So that's the type of loss that we want to make sure we insure against, because one, it's unforeseen, we don't know if it's going to happen, and two, it's catastrophic if it does happen. Now you contrast that with something like light bulbs going out. So say that an insurance company offered you insurance on your light bulbs. Now you know those are going to burn out, and for most people that's not really a material cost. And so if you have a situation where you're insuring against light bulbs burning out, what you're doing is you're adding a third party into that transaction. So now you've got a light bulb company that needs to make a profit, and you've got an insurance company that needs to make a profit. You're passing money through more hands on something that you could really just cover yourself, and so that's not the type of loss that you'd likely want to insure against. So in general, the less insurance that you can get away with, the better off you're going to be, and the less money you're going to pay in the long run. So the question really comes back to, what's a catastrophic loss for you? And the first place you want to look at is going to be at your emergency fund. So if you have a $2,000 car repair, is that really going to set you back? Are you going to have to put it on a high interest rate credit card that takes years for you to pay off? That's going to be difficult to recover from. However, if you have $5,000 saved up in an emergency fund and then a $2,000 repair comes along, it's not going to be fun to pay that $2,000 repair, but it's not going to significantly impact your financial future. And if you want to learn more about how to build an emergency fund, make sure you check out the link in the description below. So there's really two key contributing factors you want to think about when you're considering what type of deductible to have. One is your ability to withstand any type of significant loss. The more of an emergency fund that you have built up, the higher of a deductible you should be willing to accept. The benefit you gain from that higher deductible should be lower premium levels. The other factor you want to try to estimate is how likely you are to have a loss. So consider with home insurance, the average homeowner files a claim about once every 9 years. So if you increase your deductible by $1,000 and then saved around $120 on your premiums every year, you're likely to come out ahead. So in short, when you're shopping around for insurance, you want to make sure that you're insuring against the losses that you really want to insure against, and really nothing more, because ultimately paying premiums on those is going to cost you more in the long run. We would all love it for somebody else to pick up our tab on any unexpected expenses, but just remember there's no such thing as a free lunch. Opting for a higher deductible in the long run is likely to pay off, assuming that you can afford it. If you enjoyed this video, make sure you drop down and hit the like button, subscribe if you haven't already, and for the simple dollar, my name's Dustin. I look forward to seeing you again soon.